Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. It's going to be another great episode today and one that I'm super excited for. Equities have been on a very solid run. In fact, US equities have only experienced 3 years of negative performance over the past 20 years. And one of those years was 2008. So it can be easy to forget about risk during these years of solid performance. When things are going well, equities are producing an annualized 11% return. Well, I have on the perfect guest on today to talk about investment risk and why it still matters. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions. I'd like to welcome Walker Williams. Walker is the Chief Market Strategist of Private Wealth at Lido Advisors. Walker, thank you so much for coming on the show. It's such an honor to have you on. Like I said, I'm excited to talk about risk with you. It's really the foundation of what Zephyr was based on some 30 years ago. So can you please tell us a little bit more about yourself and Lido Advisors?
Certainly, Ryan, and pleasure to talk to you as well. I'm going to start first talking about Lido Advisors. The first thing I really need to mention is the name. If you ever travel around the world, Lido is named after the break island that shelters and protects Venice, Italy, and it has forever. So the name is derived from the name of that island, just simply by coincidence. It's also where our founder vacationed in Lido Island in Orange County as a child. So we really feel the name fits because as a firm, we really try to shelter and protect our clients, which is relevant given our conversation of risk today. As you noted, I am the Chief Market Strategist for Lido Advisors. Our firm, started out as a family office in the early 1990s and has sort of transitioned into a multifamily office and now a fully integrated RIA or independent wealth management firm. We really put our cadence on giving that sort of holistic experience to our clients between not just investments, but knowing how that sort of matters within their trust and estate structures, tax, and putting that all together. We're nationwide, but we're based in Los Angeles, so not too far down the road from you in Lake Tahoe.
Yeah, not far at all. Great, that's fantastic, and it is a very appropriate, and that's why we're talking about risk. Is you guys, you have so much experience and knowledge on risk. So speaking of risk, what type of risk do you and your team focus on when evaluating an investment or a portfolio?
I do think we have to say this here. Conversations about risk can get very statistical and quantitative right off the bat. So I do want to acknowledge those things do have a place here, but in this conversation, we want to take a step back and really get to why does it matter? How are we thinking about it? And ground it in basic terms with that. I do have to say, Ryan, I'm very familiar with Zephyr, and as I've mentioned to you in the past, it really was a key tool for me when I was an analyst back in the day. When we think about risk, for me, it really comes down to the foundational view of what does this mean for the client? I've spent a lot of years on fixed income trading desks where it was pounded into our mindset. Do you get paid back? What happens with? And, here at Lido, we still live in that reality of, hey, if we're going to deploy our clients' hard work capital in something, we better understand, if something goes wrong, where are we in the capital stack? Do we get paid back? What is this actually going to generate on a cash on cash basis? And this really comes in from our foundation, starting out as a family office, where the question really wasn't, how much can I make? The question is, how consistent are those returns? What is the cash flow? And if I own this thing, what I'm going to say, quote unquote, forever, let's just say 10 years plus, do I still want to own it? And those sort of foundations, I think, are, as you said in your intro, exceedingly relevant today. Because if we look at the market today, and obviously the Magnificent Seven makes up a disproportionate amount, I think it's 30-ish% of the market right now. That's really high. I still have post-traumatic stress about the internet bubble, so like it is related. But those sort of things, it's like we really kind of gotta ground it in that. It is simple and it seems very basic, but I do want to say it. If you're going to make an investment, do you really want to own this long term? And if you do, great. You got to sort of say, what's the worst thing that could happen here? Now, I'm going to give you a very simple example, but I think it's relevant. You know, if you look at municipal bonds, okay, obviously the reason why you own bonds is income, capital preservation, and offsetting equity volatility. But then there's the next level with that. Are you protected? Now, I'm sitting in Los Angeles today. You know, in municipals, the Los Angeles airport, or LAX specifically, is a great example of how you should think about risk in an asset class that most typically don't think is risky. You know, if you look at Los Angeles International Airport, they issue municipal bonds, right, to fund their CapEx terminal redevelopment. You know, but if you look more into those bonds, they're considered revenue bonds, meaning like that entity, the revenue it generates pays for the debt service. And LAX specifically, they had a bond in the past where in the due diligence of the bond, they said something that was very powerful from a risk management perspective. They basically said they had to hold enough cash in an escrow account to cover a few years of debt service. Now, when we look at that bond, that changes the dynamic of it from as an investor standpoint. It's like, great, if another COVID happens and no plane takes off or lands for a period of years, they're still going to pay me. This is a simple example, but this is the type of thing as I just go into. Like, do you want to own this long term? Let's look at this very nuanced. Now, most investors don't go into that type of detail when they look at an investment, but I think, you know, advisors and investors should sort of be thinking in that mindset and how they approach it. Now, there's all those statistical metrics we look at, and you look at the balance sheet, leverage factors, things of that. But it really comes down to when you look at that, grounding into the basis of, do I really want to own this long term? Hey, let's play the what if game. Am I still comfortable? And I think if you drive it back to that today, it's really important. I think the euphoria the market has today, this is the time to be thinking about that. You know, momentum's great. Hey, I want to ride this ride, right? But you don't want to stay too long. You know, it's to your point, that fact you stated, like 3 years, that's kind of a lot, right? And I don't want to be the perma bear, but I feel like part of my job is to be a perma bear. Like, where, you know, that kind of thought of, what if this happens? What if? Like, what are the reasons not to do this? What are the reasons to do this? And that kind of discipline is important today.
Yeah, that's fantastic, Walker. And I often talk, you know, say, keep it simple, stupid, right? And sometimes we can complicate things to the nth degree when really it doesn't need to be. And that's what I love about what you just said is, you know, are you going to get paid back? Really, that's what's most important at the end of the day. You hold the bond, are you going to hold it till maturity, or are you going to get paid back? And what's the credit risk there? We talked earlier, we could talk all day about skewness and but and that helps tell the story, and could be a very important story. But at the end of the day, does that really matter when you just want to get paid back, right?
Yeah, and I think you're right. It's like, if you look at anything in isolation, it's like, if you put $100 in, you want at least your $100 back, right? And then you can make the assessment of like, great, will this give me 110 over what period of time, and that sort of thing. But I think you really got to ground it in that. And, you know, today there's a lot of investors who are like, look at this, I did X, you know, over the past period of time. I always like to jokingly say, I'm like, they always tell you about your winners, but they never tell you about their losers. Las Vegas is a great example about that. Those casinos were built on the probabilities not being in the gambler's favor. And you know, it's sort of like, you have to ground yourself on that. You know, it's really easy to say, hey, everything's through rose-colored glasses, right? This just goes up and to the right. And over time, yeah, the market should move up and to the right because the economy is growing, things of that nature, but it's not a straight line. And, you mentioned 2022. That was a nice reminder of what can happen. And especially here, where you sort of have this transition of fiscal policy, right? Where rates were held down for a long time. Now, that's great from an investment standpoint, but it also causes some unintended consequence. Like, right, we have to, the inflation, the adjustment, the rebalancing of the economy, those all have direct implication on investments. And those, statistical measures, not to give anyone post-traumatic stress about statistics classes they might have slept through in high school and college, are key with that. But you got to sort of go like, why? What is this? Why are we doing this at the core? And then use those as tools to guide that conversation.
Fantastic. I'm going to ask you one question about stats real quick, and then we'll move on. And it's about standard deviation. Standard deviation, It's always kind of been the go-to risk statistic for wealth management, and rightfully so. It's easy. People understand it. It's kind of the granddad of risk or volatility statistics. But is it time, you think, for wealth management industry to reconsider how it views and evaluates investment risk?
I do. But when we talk about standard deviation, let's first define what we're talking about. Now, commonly, people use the statistical metric of standard deviation as volatility. Essentially, what that means, the simplest thing is how far something moves, either on the upside or the downside. Now, when we use the term volatility, people think a negative connotation, right?
Yeah.
Oh, it's going to move down. It's going to be, that's not great. However, it also is positive, meaning does it move up? How big does it move up? Now, if you tell me I can take all the positive volatility in the world, I'd be like, great, I want the thing with the most positive volatility possible all day. But that doesn't really tell the standpoint of risk, because as you mentioned, over the past, there've been all these up years. So that's all positive volatility. Yeah. In the simplest term, statistically speaking, please forgive me, there's other metrics that talk about losses, I think, more accurately. People use the term value at risk, or VAR for short. I think that's a little bit better because it's talking about, hey, if I invest this, how much of my investment is at risk of doing something adverse? Or if you get really sophisticated, again, my apologies for causing post-traumatic stress by saying about this, there's another metric called conditional value at risk, or CVAR. I think that's a little bit more eloquent when you're thinking about downside. But then there's even simpler topics like downside capture. When the market gaps down 10 or 20%, how much of that do you capture? I think that's really key for advisors and investors, in a simple way of talking about it, not the other, sort of more complex topics. It's like, hey, if the market's down 10, how much am I down? Okay, great. You have a 60% downside capture. You're capturing, you'll be down 6 when the market's down 10. That's a better way of thinking about it. And the other thing by that, we're sort of taking outside that positive volatility out of the equation. So things like that, I think statistically we should ground into. You can always use beta. Now, beta is a market sensitivity metric. The simplest way to say it, hey, if the S&P 500 is down 10 and you're down 10, you have a beta of 1. So, but that's also downside capture. If we're really driving that home, I think those metrics should be talked about more than they are. And they're also, my personal opinion, a little bit easier for an investor to understand than, hey, here's conditional value risk, here's this, here's that. I think those, if we just reground it in simplicity to the, as we're talking about, I have $100, the market goes down 25%, I'm going to capture half of that. We're sort of grounding in that.
I think that's fantastic, Walker. And you put in such good term. I personally think investment risk is losing my money, right? What you started at the very beginning is, am I going to get paid back? Right.
Yeah.
And I think investment risk is, if it hits the fan, am I going to get, how much am I at risk of losing? And like you said, I am happy as all get out when upside volatility is 20%, 25%. Give me all that volatility
Yeah.
that you can take. It's that downside volatility of how much can I lose when it goes bad? What's the downside? That to me is risk, not, losing my money. And we focus a lot on the pain index and pain ratio,
Yeah.
which captures the downside. Like you said, there's other statistics that, and it all goes back to understanding your client. You don't want to lose your client in talking about potentially VAR or CVAR, but you know, maybe there's easier statistics. Like you said, downside capture is a fantastic way of showing that that is easier to understand.
Yeah. And to your point, it's, you know, we're talking about risk here. Obviously, there's the other side of the coin, which is return, to your point of positive volatility. But like the pain ratio and the downside capture, it's like that's pretty simple. It's like, to go back to an example, obviously most investors have experience with real estate, right?
Yeah.
Hey, I own a house, or I'm renting a house, or I have a mortgage. Those sort of things is a great way to illustrate risk. I found over time, if you think about it, you have $1 million house and a 2008 happens. Okay, you paid $1 million for the house, but if you sold it today, you're going to get 700,000. All right. Like that's an example of downside real quick, or a pain ratio. Now they have the decision there not to sell. Right. But on the other side of that coin is if you're deploying capital at that time, you're buying at a very attractive entry point as well. So like those sort of simple analogies work when we're thinking about risk, but it's not just with houses. We can use a stock, we could use a bond, we can use any type of investment and put it in that term. Now, back to that example, I paid $1 million for a house. It's now worth 700,000. Am I comfortable? Now, you as an investor might be like, I love my neighborhood. It doesn't matter.
Yeah.
Great. Just keep holding it. But if you did that in a speculative aspect, that's where the pain index comes in. It's like, whoa, I did this for some other reason besides I love it. Am I still comfortable? Right? Because I still have the carrying costs associated with it.
Fantastic. We often talk ever since COVID and markets, I kind of think have gone irrational a little bit with meme stocks and we've got the roaring kitty is roaring again and meme stocks are making a comeback. Does asset allocation, and we talked about like beta and some of these statistics that are based on modern portfolio theory, does it still matter, do you think?
I think it matters more than ever.
Okay.
At Lido, we could have a debate of how much return does asset allocation drive? You could say 90%, I could say 98, we'll probably settle around 95. It is exceedingly important. And I'd argue as a financial advisor, it is the number one lever you can pull to affect returns and risk. Now, this is where Lido gets a little bit different. We don't think asset allocation is stagnant. It's not, hey, 60% equities, 40% bonds permanently. You have to move it around based on conditions. I'll give you a very simple example. Coming out of COVID, the Federal Reserve was pretty open that they were going to raise rates, right? Like, hey, inflation's high. We got to get out of this party. We could say, did they get out too late or early enough with sort of tightening the monetary condition? What I mean by that is making money more expensive. Now, in that environment, if you had 60% equities and 40% bonds and didn't adjust it, you stayed put. But if you really think about it, if you're going to rise interest rates, how do bonds adjust in the market? Well, their prices have to fall to get an interest rate that's market level, right? If you're going to rise rates, those prices have to fall. Okay. In that scenario, you should really be thinking as an advisor, do I want 40% bonds here? Because the Fed just basically told me the prices are going to fall. So if you're sitting there, you got to move the asset allocation around because you're like, I know what the train's coming. do I really want to ride this out? And if you think about it, back to what I said earlier, bonds do three things. They provide income, they protect your capital, and they're supposed to offset equity volatility. Well, in a rising rate environment like COVID, rates were basically zero. So they're not really giving you income.
Yeah.
True, if you hold them to maturity, they do have the propensity to return your capital. But because rates are so low, they can't really offset equity volatility. So as a financial advisor, at that point, you have to think, what else is there to create that for my client? Is it bonds? Great, it could be. Or is it not? So that's a real simple example of you have to move asset allocation around for that period. Like, right, you might have been better off in cash for like protecting your capital and then going back into the market at a higher rate, at a better credit quality than you were before. But that's a simple example about moving asset allocation. I think it matters now more than ever.
Okay.
I don't think it's set it and forget it.
Yeah, I agree. And look at 2022. You brought it up earlier. It's prime example. Nothing worked 2022, right? And this is going to go to our next topic about diversification. Is diversification overrated? Yes, we can focus on 2022, and that might happen again where both equities and fixed income fall together. It doesn't happen very often. Chances are it might happen again. But is it overrated? You have the S&P 500 that is outperforming the EFI, emerging markets, you name it. It's like, so why, Walker, why should I invest there, put a portion of my allocation in EFI or international when S&P 500 over since the great financial crisis is, outperformed it by like 8-9% annually?
Well, that's a great question, right? And I'm going to say something a little bit controversial with this. Here at Lido, we don't believe in diversification for diversification's sense. All right. It all comes back to what I said earlier about that family office heritage. Every investment should be able to stand on their own 2 feet, and you should understand why you're doing it. Okay. Mm-hmm. Now, there is such a thing as too much concentration and things of that nature. But at the same time, you got to look at it all in isolation. Now, when we talk about, historically, as we know, there's been runs where international stock has done really well and then reverted. We've been in a reverted run here for a long time when looking across the pond at Europe. But there's some other questions using that equity example that I think we need to bring up. Now, there are, of course, companies globally that no matter what it is, if I look at it, I'm like, could be a great investment, not only from a return perspective, but a risk perspective. But there's some other things here that I think we need to discuss when we're talking about that example of diversification. The first thing is demographics. Now, I'm going to pick on some nations based upon demographics only, right? If you have an aging population and your population is aging, that means you're moving out of, say, savings mode into spending mode. And if that's a big thing there, what does that do for the economy? It's a simple question that you need to think about, right? If you look at different sort of basic aspects of these things, it's like, what is that? If we're investing offshore and it's not in an ADR, what is their currency going to do? Now, so many economies are trade dependent, right? What does a strong dollar look at that? What does a weak dollar look at that? Those sort of things also need to be considered. Like, if you look at demographics, I find it intellectually fascinating, right? There are trends with this. It's like, even if you look at the globe from a demographic aspect, okay, India, very, very positive demographics, okay? China, negative demographics due to their policies on one child, etc. So that's an interesting overlay when you look at those opportunities. If you look at different nations and where they are in this point, Japan's sort of a unique example with this. Positive demographics, positive growth in the 1980s. Okay. Like the Japanese were expanding. You saw them make investments everywhere. But then the demographic turn started to happen there. And look what happened to their economy. And look what happened into those investments. Now, recently, Japan has had a run up. I'd say it's really tied into technology and artificial intelligence. But those sort of things sort of matter when you're thinking about diversification. I guess the way to think about this is there's some simple things that you need to think about. Now, there's great companies out there, regardless of where they are in the world.
Mm-hmm.
But if you're taking a passive approach to that, you're like, okay, then you should be thinking about demographics and these sort of issues and geopolitical issues that I don't think people really think about. I jokingly say, when we started approaching international investing, I said, what denomination is your bank account in? They're like, dollar. I'm like, okay, if it's dollar, we need to look at this a little bit differently than it's euro, yen, renminbi, you name a currency, because that's what you're really net. We always say net taxes, net fees is what you actually have. So those sort of things, you think about it, there's definitely times to go offshore as sort of just a market play. There are times not to.
Mm-hmm.
And I feel that this is part of the nuance of the asset allocation within that equity or fixed income bucket or private bucket. Look at it more of, do I really want to own this right now? If it's just a great company, it's just a great company. It's going to stand on its own 2 feet. Putting that in your portfolio, yeah, you're going to get a diversification benefit of it. But this is part of the simplest thing that I sort of drive back to. I'm like, okay, let's look at demographics. What do you think the dollar is going to do if it's a trading-based economy? How stable is that nation?
Yeah.
What are their policies? There's some interesting research on this, but I think it's like just grind it right back to that. Sometimes gives you some insights.
That's really interesting, fascinating, Walker, that you focus on demographics there and you take a little different viewpoint of it versus just, you know, trying to reduce correlation, increase diversification through um, typical market ways. I love it. And it's hard for people, I think, and investors. They just look at a graph, like you said, the S&P 500 is just going up to the right and much higher and faster than the EFI and emerging markets. It's easy to understand why they'd be like, why am I investing anywhere else other than the spider, and just riding it out? But it goes back to demographics. Those cycles are going to change over time. I just read, can't remember who posted it, but since I think it was October 2022, EFI and the S&P 500 basically have the same return, right? They've matched it, and it's one of those cycles where now developed internationals, it's a solid place. Valuations are attractive, so well, I
Yeah,
can understand, and I've done the analytics. I've talked to you about it, where like S&P 500, when you look at risk statistics like downside risk, it's very attractive compared to a globally diversified portfolio. But there's going to be times like 2022 when you wish that you were more diversified.
yeah, and I think you're going to end up in a more diversified state, no matter what you do. If you really just go back to the basics and say, I like this, I like that, great. Manage size constraints, and we do that at Lido. We're very specific about, hey, you can't have a very concentrated position in certain things. But if you just come back to that grounding and you say, okay, this is why I own this, I like this, down from what it does on the downside, I think I'm going to get paid back, and it has attractive growth characteristics, great. That plus this in a different area, that's diversification. But it's more than just a headline, right? I'll give you a simple example. If you think about lending in general, like me borrowing to a company or real estate, there's a concept called loan to value. Essentially, it's like, how much am I, if say it's worth $100 and I loan them 80%, $80, that's an 80% loan to value. But let's take a step back. Now, what that really says to me is, what I'm saying is, okay, if that price falls 20%, that's where the equity is my buffer, right? Okay, with low interest rates, I'm more comfortable with that than I am now. So right now, if I'm going to lend on something, I want more buffer to protect me. So what is the right amount of a loan I can put on that or loan to value. For us today, it's like 60% or 50% because of that buffer
Yeah.
that investor has to absorb before it affects me. That's really driven on what we see today. So that's a simple example on that.
Fantastic, Walker. Such a great conversation. I'd love to have you on again. Talk more. I love it. I love talking about,
Yeah.
the inner workings of, modern portfolio theory, risk, and you brought in up some great points about, maybe different ways of looking at risk, and then that's more traditional, just looking at a bunch of statistics. Thank you so much for coming on the show with that great insight. Where can our audience get more information about Lido Advisors?
Well, Ryan, thoroughly enjoyed it and look forward to continuing the conversation in the future. The best way to really learn about Lido Advisors and our firm is go to our website, www.lidoadvisors.com. There's a lot of great resources, thought leadership, and explains how we're differentiated in the marketplace. But after going there, if you're interested in learning more, there's a contact us button, and we'll get back to you very shortly. We're also on various social media platforms, and you'll see some different postings from us, especially on LinkedIn. But that's the best way to, get in touch with us and see what we're doing and how we're thinking here in this current environment.
Awesome, Walker. Thank you again, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel, as well as on Spotify and iHeartRadio. Thank you very much, and have a great rest of your week.